70 minutes. That's how long it took for $4 billion to evaporate from the silver market, not days. Not hours. 70 minutes of pure chaos that nobody saw coming. Silver had just kissed $83 per ounce, a record high we hadn't seen since the 1980s, and then it plunged 11% before most traders could blink. The whispers started immediately. Market manipulation, emergency Fed bailouts, institutional collapse. But when you look at the trading volume data, something far more interesting emerges. This wasn't a conspiracy. It was a liquidation cascade so violent that it rewrote the playbook on commodity volatility. Let's rewind to where this actually began. Silver started 2025 around $28 per ounce. Boring. Stable. Most analysts predicted another sideways year. But beneath the surface, something massive was building. Industrial demand was exploding silently. Every electric vehicle needs 30 grams of silver. Solar panels are silver intensive. Data centers require massive amounts for components. By March, silver crossed 35. By June, it hit 50. Suddenly everyone remembered precious metals exist. Fund managers who'd ignored commodities for a decade were scrambling to get exposure. Reddit forums lit up. YouTube channels multiplied overnight. Everyone claimed they predicted this move. The fundamentals kept tightening. Mine supply couldn't keep pace. Recycling rates were dropping. Industrial consumption kept climbing. It was a perfect storm, and silver just kept pushing higher into thin air. December arrived, and silver crossed $75. That's a 158% annual gain. Spectacular by any measure. But here's what most people don't understand about silver. It doesn't rise smoothly. It explodes. And when it explodes, the trading mechanics get absolutely unhinged. December 28th hit, and silver touched record highs above $83. Trading volumes went absolutely insane. COMEX silver volumes surged to levels beaten only twice since 2020's COVID crash, followed by a massive spike in Shanghai Futures Exchange turnover. Everyone sitting on the sidelines was trying to pile in. FOMO was driving price action harder than fundamentals. People who'd never touched commodities were buying futures. And then, without warning, it reversed. Silver tumbled 11% in its biggest intraday decline since September 2020. Not a gentle pullback, a vertical cliff dive. $4 billion in market cap just vanished. Stop losses triggered in cascading waves. Margin calls started hitting every account that held leverage positions. Here's where the volume data tells the real story. On December 29th, the Chicago Mercantile Exchange raised margin requirements significantly. This wasn't announced during trading hours. It came after the close, effective immediately the next session. Traders woke up to emails saying they needed to post substantially more collateral or face forced liquidation. Most didn't have extra cash sitting around. They had one choice: sell everything now. And when everyone tries to exit a crowded trade simultaneously, you get a liquidation cascade. Each sale pushes price lower. Lower prices trigger more margin calls. More margin calls force more sales. It feeds on itself mechanically, ruthlessly, with zero regard for fundamental value. This wasn't manipulation. This was the market's pressure valve releasing before the entire system exploded. Silver trades with roughly 1.7 times the volatility of gold. It's smaller, thinner, and way more leveraged. When gold moves 1%, silver typically moves nearly 2. That multiplier effect is beautiful on the way up. It becomes absolutely brutal on the way down. The thing people forget is silver isn't just a precious metal. It's also an industrial commodity. That dual nature means it gets hit from both sides during stress. Investment demand vanishes when traders panic. Industrial demand projections get slashed if recession fears surface. You get a double impact that gold never experiences. So when that margin hike hit and liquidation started, silver didn't just correct. It collapsed. Every algorithm, every risk system, every broker desk was dumping into a market with almost no buyers left standing. Now here's where conspiracy theories exploded. On December 31st, People noticed the Federal Reserve standing repo facility showed over $70 billion in activity. They immediately connected it to silver's crash. Massive liquidity injection right after metals mayhem. Can't be coincidental, right? Actually, it was. The standing repo facility is permanent infrastructure. Banks borrow cash overnight by posting treasury securities as collateral. It's not emergency intervention. It's routine year-end liquidity management that happens every single December. Banks need extra cash to manage balance sheets for regulatory reporting. They borrow from the Fed, pass their year-end snapshot, and pay it back in January. This pattern repeats annually. The timing with silver's crash was pure coincidence. The Fed doesn't care about silver prices. They care about keeping the banking system liquid and functional during year-end reporting periods. But one real phenomenon did fuel the conspiracy theories. Physical silver was trading at massive premiums in certain markets. Shanghai premiums hit record $8 per ounce over London spot prices on December 24th. That's enormous. Someone in China was paying $8 more than global benchmarks to get actual metal in hand. That spread tells you something real about localized supply. But here's the nuance everyone misses. Premiums don't necessarily prove manipulation. They reflect logistics, local demand surges, import restrictions, currency controls. China experienced a silver investment frenzy throughout 2025. Retail buyers piled into coins and bars as the yuan weakened and domestic investment options looked unattractive. That created regional scarcity even though global supply wasn't critically tight. Yes, physical and paper markets disconnected, but that disconnect has always existed to varying degrees. It widens during volatile periods. It doesn't prove paper prices are fake or someone's hiding insolvency. So what happens next? Silver traded back around $74 by January 2nd. It recovered most crash losses in just days. That's not the behavior of a market that experienced systemic crisis. That's a market that had a leverage flush and then resumed pricing fundamentals. The case for silver hasn't changed. Supply deficits remain real. Industrial demand keeps growing. The energy transition requires massive silver quantities. What changed was extreme speculation got washed out violently. Traders holding positions they couldn't afford are gone now. What remains are longer-term holders who actually believe in the metal. That's healthier foundation for whatever comes next. Here's the real lesson. Silver didn't need conspiracy to explain what happened. Margin hikes during parabolic moves are standard risk management. Liquidation cascades and leverage markets are predictable mechanical events. Year-end repo operations occur every December without fail. Physical premiums reflect regional supply dynamics, not global manipulation schemes. When you understand how markets actually function, the mechanics explain everything without needing hidden hands or institutional collapse theories. The violence was proportional to how over-leveraged the market had become. Nothing more, nothing less. If you're trading silver going forward, understand this fundamental truth. The metal will do this again. It always has. Silver doesn't trend smoothly. It spikes, crashes, whipsaws, and punishes anyone who doesn't respect its volatile nature. The story isn't over. We're days into 2026, and silver's already showing life again. Maybe it runs back toward December highs. Maybe it consolidates for months. Maybe the entire rally was a speculative blow-off and we're headed back to 50. Nobody knows for certain, but understanding what actually happened beats inventing theories every single time. Real market mechanics are fascinating enough without fabricating crises. If this breakdown helped clarify the chaos, smash the like button. Share this with anyone confused by conspiracy content flooding social media. Subscribe for reality-based market analysis instead of hype and panic. Drop a comment with your prediction. Is silver going back to 80? Or are we headed below 60 in Q1? Let's discuss it. Truth is always more interesting than fiction.